Welcome back to Factful Finance, where we make sense of the complex world of money. Today, we're diving into something that sounds a little like financial wizardry, but is crucial to understanding how markets really work: arbitrage and market inefficiencies. Let's break this down so you can start seeing the financial world in a whole new way. Now, I want you to imagine this. You walk into two different stores, and you find the same exact pair of sneakers. But here's the twist. One store is charging $100 and the other is charging $150. Seems odd, right? That's a perfect example of market inefficiency. Ideally, both prices should be the same. But in reality, due to various factors like timing, location, or just sheer oversight, prices can fluctuate. If you knew about the price difference and bought them from the cheaper store, you'd be taking advantage of arbitrage. Arbitrage is simply the act of exploiting price differences of the same asset in different markets. You buy low in one place and sell high in another. It's like an opportunity to profit from discrepancies that shouldn't really exist. You can apply this concept to anything from currencies to commodities to stocks. But here's the catch. For arbitrage to work efficiently, the market needs to have inefficiencies. And inefficiencies? They don't always last long. Let's break this down further. Markets are constantly adjusting, trying to reflect all available information. But even with all the data and sophisticated algorithms, there are moments when prices don't align as they should. That's when an arbitrage opportunity opens up. Think of it as a glitch in the matrix that savvy investors can exploit. Let's look at a real-world example. Imagine you're Emma, and you're trading stocks on two different platforms. You spot a stock being traded for $10.50 on one platform and $10.75 on the other. If you have enough capital and the trading fees are low enough, you could buy the stock on the cheaper platform and sell it on the more expensive one, making a nice profit in the process. But you've got to be fast. These opportunities rarely last long enough for the average investor to capitalize on them. But here's the thing. Arbitrage opportunities don't come up every day. They're rare, and they usually require a significant amount of capital to take advantage of. Plus, it's important to consider transaction costs, those hidden fees that can eat into any potential profits. So why do these inefficiencies exist in the first place? Well, they happen for several reasons. Market participants might have different levels of access to information. Technology might not be fully synchronized, or maybe regulations prevent prices from aligning perfectly across borders. Now, let's get into something that might be a little more familiar to you. You've probably heard about Forex trading. It's one of the most popular forms of arbitrage, currency trading. You might notice a discrepancy in the exchange rates offered by two different brokers. The trick is to move quickly before the rates adjust. It's like playing a high-stakes game of who's faster in the financial world. But here's an important point. Arbitrage isn't just for billionaires with massive computers running complex algorithms. There are everyday applications too, like shopping around for the best price on a product before purchasing it. That's right. This concept applies to almost anything where there's a market, whether it's shoes, stocks, or even buying a used car. Of course, with great opportunity comes great risk. Arbitrage isn't always risk-free. A sudden market shift, unexpected news, or transaction fees can all turn what seemed like an easy profit into a loss. The markets are never static, and even the slightest change can close an opportunity. This is why professional traders use algorithms and super-fast trading systems to monitor these inefficiencies in real time. So why should you care about all this? Well, understanding arbitrage and market inefficiencies gives you a deeper insight into how financial markets work. It helps you understand why prices change, how you can spot opportunities and risks, and how markets are constantly adjusting to information. Even if you're not trading professionally, having this knowledge can make you a smarter investor, better prepared to navigate the ups and downs of the financial world. But here's the catch. Arbitrage opportunities are becoming fewer as technology improves. Markets are becoming more efficient over time, which means these gaps don't last as long, and the transaction costs are sometimes higher than the profit you could make. This is why it's crucial to stay educated and be aware of the risks. Before we wrap up, remember, This content is for educational purposes only. If you're diving into any financial decisions, always consult a certified financial professional to ensure you're on the right track. So, how does arbitrage impact your financial journey? Are you seeing ways you could start applying this knowledge? Drop your thoughts in the comments below. I'd love to hear what you think. And if this video helped you understand arbitrage a little better, don't forget to hit that subscribe button so you can stay ahead of the curve on the latest financial insights. If you found this helpful, check out what's coming next. You won't want to miss it. Click the video on screen now to keep building your financial knowledge.